Hey everybody, Lisa Dean here with Real Broker, your favorite Mass-based local realtor, and today I am accompanied by my friend Joe Sarcia, and we have known each other for, oh my God, almost 2 decades.
Yeah.
You believe that?
2 cars ago.
2 cars ago. But today we're going to help provide some solutions for you and some great information, so make sure you stick around. We're going to talk about what it's going to take to qualify you, whether you're looking at a single family home or even a condominium.
That's right.
All right, and again, we service the suburbs north and south of Boston, but hopefully this resonates with you, and we hope that you find it beneficial. All right, so why don't we begin? Joe, why don't you start by helping us understand what a borrower needs to do to qualify?
Qualify, you have to, the typical number that Fannie Mae and Freddie Mac give you goes to 45% of your gross monthly income. So that's kind of the magic number that they use to qualify you for your principal interest, your taxes, your homeowner's insurance, and if you're buying a condo fee. And if you're putting less than 20% down, you would have private mortgage insurance. So those numbers have to be within that that qualification number of 45%. And all the other debt comes in after that. So if you have car loans, or if you have student loans or credit card debt, that comes into the back ratio, and that can't be more than 50% of your income.
Now,
it's on a typical conventional mortgage.
I know sometimes you recommend to clients to help them get a particular loan. They might need to pay off a car payment or something of that nature so they can bump up their debt to income ratio. Is that right?
Bump it down.
Or bump it down, sorry.
So if you have the assets to do it, and you want to, if you need to pay something off, you can do that. So that's one option that you have. And typically, people can pay off anything. It can be a car loan, a student loan, or a credit card. And easy to do. Really the 4 things that the banks and the government looks at to qualify are: one is the property, which you have no control over. It's just done by the appraiser, and it's if the realtor has done her job, it's in the price range of what she thinks it's worth. So part 2 to it is the assets. You have to have the assets to put down for a down payment, and a little bit of a reserve. So a reserve would be a total of your mortgage payment, which would be, again, the principal and the interest, taxes, the homeowner's insurance, the PMI, and again, if it's a condo, the condo fee. So that gets looked at. So you have to have a 2-month history. So the banks will ask you for 2 months of documentation on that to control, to look at your assets to make sure you have sufficient funds. The third thing they look at is your income. So income is a variable to the mortgage industry. So typically you would get, if your salary, it would say that right on your pay stub, you're a salary employee, and we just take that number and we can use that even if you've been at the job only a couple of months. The curveball to it is if you're hourly, and you're an hourly employee, which I see a lot of,
yes,
they take a 2-year history. So what they want to see is they want to see consistency in earning money, that you're not just working heavily now in the first couple of months of obtaining the mortgage, but in the last year and a half you didn't make the money. So people out there, you have to, if you're hourly, you have to take a 2-year history of that income to use as your monthly income for qualifying for that principal, interest, taxes, and insurance.
Oh, by the way, Joe, what other programs are available when talking about condos and FHA?
So FHA is a different product than Fannie Mae and Freddie Mac. So the way I list it is Fannie Mae, Freddie Mac is McDonald's, FHA is Burger King. It's kind of the same menu, but typically FHA gives you a little bit more in qualifying. So instead of a 45% ratio to qualify based on your income monthly, it's 46.9. Strange number, but that's the number they use. And instead of stopping at 50% with all your other debt, your car payments, etc., it goes to 56.9. So it allows you to buy more of a house. And their rates are a little bit better. So it's actually been a great program. They've actually started reducing their PMI, because the PMI with FHA used to be expensive, but they changed that. So if you have to go that avenue, you can. The typical down payment for a conforming mortgage with Fannie Mae and Freddie Mac can be as little as 3%. When you're dealing with FHA, it's 3.5%, so it's not too much of a difference. You like mayonnaise on the hamburger. So those are the two basic differences with it. But when you buy a condominium, the condo complex has to be FHA approved. And it's nothing, the borrower can actually look it up online. You can look up on a website, the government website, if the project is FHA approved, because that has to happen in order for you to buy that condo. And if it's expired, which a lot of them have, we actually have a bank that actually will do the research and actually send the paperwork in for you, so that way you're not burdened with that, and to get the condo back on being FHA approved, so we can handle the whole thing.
That's fantastic.
Which is a good thing. Yeah. So they're a little bit more flexible on credit scores. So if your credit scores are a little different, for a conforming mortgage, the credit scores have to be above 620, and that's the last piece of the property, the assets, the income, and the credit score. So your credit score on a conforming mortgage has to be above 620. If you go on FHA, it's 580. So they give you, I call it like the church, they'll take everybody.
Aww.
So that's one of the advantages with FHA. And there's ways to actually move your credit score. So if you're close to having a 620 credit score and you're at 611 or 599, you can actually pay something off. There's a formula with the credit agencies that, like an algorithm that tells you what you need to pay off to get your credit score to move 9 points. So when you have a credit score that you don't like, you can actually change it.
Great. All right. And then in terms of condominiums, could you help explain what's involved with walls in?
Yes, that's come up probably within the last 10 years. So typically, when you buy a condominium, the banks, myself, and the government want paperwork from that association that holds 50, 60, 70 units, whatever it may be. And these documents are available, and usually the association that controls it has to provide us with a condo questionnaire that tells us how many units are owner occupied, which is important. And they have to give us the master insurance. The master insurance has a set of words in it that's called improvements or betterments, and you can ask for it from the seller or the association when you start looking at condos. And it has to have the words of improvements and betterments, or the words walls in. And if it has those words, that means anything on the interior of that property. So if a wall gets damaged because a unit above has a water leak, you're covered by the association. They pay it. You have nothing to pay. So if it has that walls in coverage, there's no money out of pocket from you. But if it does not have that verbiage in it, then you as the homeowner have to get your own policy. So it might add another expense, and qualifying for a condo could be $30 a month. It's not that expensive, but you are responsible for it, and it goes in your debt to income ratio to qualify.
Oh, well, there you go. I hope you learned a lot today. I know I will. So definitely re-listen to this entire video so that way it can really sink in. And Joe, thank you so much for taking the time to explain all of this. I really appreciate it. We'll have to do it again.
Yes.
And in the meantime, guys, keep liking up these videos, subscribe, and if there's any other concerns or questions that you may have about real estate that you'd like me to answer for you in a video format, please feel free to put comments down below in the comment section, and I will jump right on that. So thanks again. A lot of people who do watch these videos do reach out to me. I'm here to help you. Joe is here to help you. We're going to have our contact information below. And I look forward to seeing you next time. All my best, and keep smiling. Bye.